Welcome back to another Money Not Math conversation. This is episode 177 with Dusten Hendrickson and Mailbox Money on March 10th. Hope everyone's having a beautiful day wherever they're watching from. I know up here in northern Minnesota it's a little chilly outside, but I know people watch from all over the country, and hopefully today's conversation brings you value. So, Dustin, thank you so much for taking the time to have this conversation with me today. I know a little bit about you. You bring over 20 years of experience, $500 million plus of experience in real estate development, design, construction, and syndication. You specialize in strategic land selection, wellness-focused design, and leading projects from concept through completion, with focuses on delivering strong investor outcomes while addressing the affordable housing crisis. So that's a little bit of an introduction of you, I guess 30-second elevator pitch. But tell us a little bit about yourself and let the viewers get to know you a little bit.
All right. Well, thanks for having me, Drew. Um, I just love real estate. I've been involved in real estate my whole life. Well, my whole adult life. And from owning a roofing crew to building houses to then building apartments and to getting out of building because I realized I like design better than building. And then now helping other people invest and trying to solve the affordable housing crisis. It's all about designing very efficiently and trying to do it sustainably, both financially sustainably, which is the most important because if it's not financially sustainable, it breaks down. And then also environmentally sustainable because that's just going forward, that's what we need to do. We need to decrease operational expenses any way you can, and being economically sustainable is one of those ways. And I feel reducing square footage is the best way to be environmentally sustainable.
Okay.
And so it also helps financially, being financially sustainable.
Absolutely. So, if I heard you right, you started out building or working in construction, then you owned your own business, roofing, and then you transitioned to um, kind of the architecture of the build, not actually doing the build. Is that kind of a
Correct.
some fair summary of what you're doing there? And then you went
Yep.
from designing the building to investing into it for other people, or utilize other
Yeah,
people's money, or how does that
exactly.
work? Is it like a private equity fund, or are you connecting the dots, or how does that work for you to help others invest in real estate?
Yeah, it's private equity we're involved in. We raise private equity, and each deal is a syndication. So we just bring a group of people together. And so we hire the best professionals, lawyers, CPAs, property managers. We manage the asset, and then we pool everyone's funds together. We sign on the bank notes. So we create an opportunity for people to invest in. And I say it's very similar. If you would take your own money and go sign on the note and buy a duplex, except for you have the responsibility, you have the liability, you have all that risk. And when you come in with us, all you're risking is your investment. And
Okay.
our returns are very, very similar.
Yeah, no, that's I appreciate a lot of what you're saying there for two reasons. First, my primary work is in retirement planning and investing, but I also own a real estate company that owns real estate, and duplex being one of them, and a construction company. So I can relate to a lot of your experience. But also here locally in Thief River Falls, Minnesota, a town of 10,000 plus people. I think it's like the healthy transference or not occupancy rate, but what's it called? Unoccupied rate is like 5% for a healthy community to have, proper pricing, moving, things like that. And ours is like 0.03% or 0.3% because we're
Wow.
such a deficit of housing due to everything you just said, right? The cost of building. By the time you get done building a new house, it's hard for people to afford. So that's interesting that you're trying to make kind of come full circle of increasing housing, but also decreasing, it sounded like, the footprint of the house to
Yep.
make it more affordable. Is that fair? So you have everything you
Yeah.
need, but in a smaller space, which up until I guess maybe recently, a lot of people thought bigger house meant bigger dreams, but sometimes that means just wasted space. Is that fair?
Yeah. And then specifically, a lot of times when you're building a big house, you can afford it. It's affordable because you have so much free cash flow and you can spend the money and you're not worried about value. You're not worried about ever reselling your home. So you're not worried about resale value. You're just buying it for your personal.
Right.
When you are dealing with investment properties or properties for the masses, you have to be cognizant of the resale value because it's going to get sold back onto the market. And for us, a lot of that is cutting all the amenities out because what we find is people do not use them as much as they think they're going to. And then once they're in that environment, they say, well, if I could cut all these amenities, I'd gladly take a $200 to $400 reduction in the rental rates. And what we're seeing is the pressure that those ongoing expenses are putting on the property. They make it's not sustainable. So something has to give.
That makes sense. So, before I ask, I have two questions. I hopefully I don't forget one of them. But what's like the most typical amenity that you see that most people have but that really don't need? So it's most commonly cut out to save money.
Um, the elevator is one that is not needed. People think it's nice to have, but when it's broke down or it smells bad or it gets something's wrong with it or it's slow, you'll get bad reviews. If everyone understands that there's never an elevator there, no one will give you a bad review for there not being an elevator. So that's one where people think, oh, a 3-story has to have an elevator. But if you go to look at a lot of the older builds, 3-story did not have an elevator. It wasn't until you went to 4-story and above where an elevator was necessary.
Okay.
So, and they also slow down the build time. So an elevator is a prime example of something that everyone thinks you need, but what we're realizing is no one really cares about that elevator. And then the other one is covered parking. So a lot of people build these garages on site that aren't attached, and those are, you'll never get your money out of them. And then we do a little bit of research. Okay, we have a spot to build a garage. If enough people demand it, we'll put a garage in this space. And what we found is we never build a garage
Hmm.
because people will take the reduction in rent over that garage.
Right.
Underground parking is extremely expensive to build now too, with the price of concrete the way it is and the additional engineering that's required. So because of that, we've eliminated underground parking, but we also did it strategically. We asked, what would you guys be willing to pay for rent for the underground parking? And when it's optional, people tend to not take it.
Interesting. I could actually, yeah, I could see that. It's one of those things that, whether it's elevator parking, if you offer for me the same price, absolutely, I'm gonna say yes. But if you're like, hey, it's gonna cost you an extra $500 a month, it's like, okay, I'll just park outside, right?
Yeah.
Depending on your life situation, because if you're in a situation where your vehicle's expensive enough that you require it to be covered in a garage, you may be owning your own home. But if you're in that situation where you're renting, you're probably not driving around a vehicle that needs to be covered. But maybe I'm wrong, but that's kind of where I'm taking that feedback is and it makes sense to me.
Yeah. The majority of people are not willing to pay $100 to cover their vehicle. It's just how
Really,
it is.
100. That's a
There,
pretty low number even. Yeah.
yeah, and there are people that are willing to pay for it, right? But there are so many places with that option. Well, they can just go to those places and we'll just reduce our rent and then we attract many more tenants. So
Right.
what we're finding is most people are price sensitive. And maybe in 2021, when people were getting free stimulus checks, maybe then everyone wanted it. But what we're finding is it's just not the case anymore, and people are definitely more budget conscious. So when we ask 100 people, do you want to park inside for $100 or outside? And 95% say, I'll just take the outside parking stall. Well, we know that we don't need that underground parking.
That's fascinating. I know that I shouldn't say for certainty, but I believe the last mock-up I saw of the next big project here in Thief River Falls for additional housing and senior living had, to your point, like a bunch of underground parking and covered parking. So I'd be interesting to know how much of that's convenience versus actually price structured to what the tenant needs. We're not going to get those answers today. I think it's just what you're saying directly impacts a lot of the projects I'm seeing, but almost on the opposite side, and it makes sense. Before I forget, though, I want to make sure I touch on this question. So, one of the most common, I won't even call it a debate because I normally don't get involved. I just necessarily hear it. But one of the most common statements or arguments that I hear when it comes to wealth and saving or investing is your home is your best investment, right? Like buy your home, invest in your home. It's the greatest investment you're ever going to make. And a lot of times you hear that from real estate agents and whatever. But what you said, I think, is really important. Please touch on this more. The difference between your home is something you own and live in an actual real estate investment. Can you just touch on that a little bit more? Because I think the
Yeah.
differentiator between those is huge when it comes to wealth creation.
Yeah. So when people buy their first home, it usually tends to be very value based. And so that is an investment that's going to be great because it's always going to be peak market. When you gain wealth and then now you go buy a ranch somewhere and you're putting a bunch of money into the home, into amenities and things, you're not going to get your money out of those amenities. You're going to get your money out of the land and the structure itself. But it's not, that's really not creating your wealth. When you first buy your house, yes, that's a really, really good wealth creator. And they also say that because most people don't have that much wealth. So if you're not going to really have very much wealth, your home is going to be your best investment. But if you want to look at how do you really create wealth, well, once you get old and you have wealth, you'll find a lot of people don't even have they don't necessarily own a home anymore. They might own a condo or they might just rent because they have so much other wealth that's making them money. You would make more money by going and renting an apartment and taking all your money and sticking it into the stock market. But that's emotionally, we don't want to do that. So there also a lot of emotion comes into creating wealth as well. And so if you're going to take the money and save it and stick it into your house, it's a really, really good wealth creator. If you just want to say, I want to do the absolute best thing, well, go live in that studio and then take all your additional funding and put it into the stock market or into a cash flowing investment. Because a home is just becomes a liability at the end of the day. But when you live in it and you're going to pay rent and you want to live in that, it's going to be a really good wealth creator. So yes, I believe everyone should own a home, but I also don't think that that is where you're going to make the majority of your money. I make way more money on all my investments than I do from my house going up in value.
Absolutely. And you touched on, I love everything you said there. And one another important point you made that I would love to fledge out more is the difference between the type of wealth we have, right? Um, you use the word cash flowing investment, right? So a buying real estate that pays you every month, that's a cash flowing investment. You can go out and spend that. If my renters pay me 4 grand this month, I can go spend that at the grocery store. If you pay off your home that you are currently living in and you have no mortgage and the value goes up by 200 grand this year, you can't go spend that at the grocery store unless you refinance, right? So
Yeah.
there's a very big difference between a cash flowing investment that you have liquid access to and you can actually apply to your life and a statement investment that
Yeah.
yes, your equity is going up, but what can you actually do with that? So do you have a preference or more you'd like to touch on between, the market can grow, but you can only spend it when you sell it. Real estate gives you cash flow monthly. Your own home is equity growth, yes, but you have limitations around spending that. Do you have any additional things you'd like to add to that, or do you feel comfortable with where we're at?
Yeah, I feel comfortable. I would just say that your house is a liability because you're not collecting everything and it's always outgo. So you're paying for it every month. Yes, you're building wealth with equity and whatnot, but when you have a cash flowing property, you have a tenant that's paying your mortgage down and you're creating additional cash flow on top. So it's
Absolutely.
not a liability at that point.
Yep, absolutely. So I think Dustin touched on some really good points, and I'll just add a recommendation to anyone watching this. Make sure you understand the difference between an investment and a liability. To Dustin's point, investments generate wealth, liabilities can cost us money. And also within that wealth, understand what you can and can't spend and how and when you could use the money you're generating. Because if all of your money if literally every dime you have goes into the home you live in, you could have millions of dollars in equity without being able to spend a dime. And then we see that with farmers a lot, right? With land and things like that. So it's important to have a balance between liquidity and cash flow and things like that. So that's your primary business, and that's called Mailbox Money, right? So
Yep.
your general premise is to help people who want to generate cash, a cash flow asset, be able to do that without all the work of needing to line up the insurance, work with the bank, find the right property. And is that correct?
Correct. Yeah. And then you can drive by it and you can touch it and feel it and you can own it. And yeah, that's what we like to do. So once you get to a certain point, so there's just two different investors, right? Do you want it to be your career investing in real estate? Because eventually it would becomes your career. If you love your job and you want to keep your job and you just want to own real estate, you should invest passively. If you want to move on to being a real estate investor, real estate professional and full-time flip and fix and rent and own, then yeah, you're just going to want to go and start small and start buying and building and going bigger and bigger, and eventually you can quit your job and just work on that. So there are two different types of real estate investors. But another thing being said is that when you are become a real estate professional, you have so much ordinary income that can be offset. Now all your ordinary income can be offset, so sometimes you'll need tax advantages. And so when you come into our deals, we can give you about 85 to 100% of your initial investment. We can give that back to you in tax paper losses.
Okay.
So
That's
sometimes
huge. Yeah.
if you're an active investor, you might not have enough depreciation. So then you might have really good cash flow years, or you sell something, you can't find anything to buy. So you can come in and buy some of our investments and defer all those taxes.
Oh, that's a really valuable resource, I imagine, for different types of people. Absolutely. Being able to find a tax loss or harvest through an investment is kind of a double win in a way, right?
Yeah.
Are all of your real estate projects new builds, or do you guys buy and renovate old properties too, or what does that balance look like?
It's all new development. We used to do some older stuff, but the value that we create when we develop is so great and it's so much more passive that we've realized that we go full in on development. Now that could change if there's a fire sale assets, if there's a time where you can go and buy assets really cheap, then we will buy some assets, but we find that there's only a few times where assets are cheap. Like in '09, they were cheap. You should have bought a lot of stuff in '09 to 2015. It was really cheap. It's hard to time the market though. So it just depends on what's the pricing you can buy for and what's the pricing you can develop at. And right now we can develop cheaper than we can buy. So it's a no-brainer to just build new.
Really? And when you say that we use the word asset, you're saying currently established homes, right? You're not, or properties.
I always refer to apartments, so larger apartments. So
Okay.
when I'm talking about stuff, I'm talking about roughly 100-unit apartments.
Okay, that's good. That's a good disclaimer. So, and if someone comes to you and they want to invest their money and they're saying, "Hey, I don't plan on quitting my job, but I want a passive stream of income, and I've heard real estate's the best way to do it. In fact, I believe it's the number one way that millionaires have been created in this country is through real estate." What's the timeline, right? Is there a minimum
Yeah.
commitment? If I give you X amount of dollars today, is there a minimum commitment to how long I'm involved? Is there a maximum? Like, what does
Yeah.
that look like? Or can I just give it to you today and demand it back tomorrow? Which I'm guessing the answer is no, but
The
there's got to be
answer
some
is
parameters
no.
to that.
The answer is no. It's almost exactly as if you buy a duplex. So if you go and buy a duplex and you want to sell your shares tomorrow, you're going to take a bath on that duplex because
Right.
all the fees to transact are very expensive. So you gotta no matter what, when you own real estate, you should plan on owning for at least 5 years. If you're not going to own for 5 years, don't buy it.
Good
And
advice.
so at least 5 years, but 5 to 10 years. So you should plan on that. Is illiquid money and it's a long-term investment. You're going to get some cash flow out, but you're probably not going to be able to sell it. And we did the overall market determines when we want to sell. So when someone is going to offer you way more than it costs to replace the property, that's when we're going to sell. So if we can build for 200 and someone offers us 250 per unit, 250,000 per unit they offer us, and we can build for 200, as the fiduciary of your money, we have to say yes, because now we can take that money and we can 1031 into the next project and we can create a massive amount of equity for you. So that's what we will do. And when we do the sale, you can choose to participate in the 1031 or not. If you want to participate, now you double your equity stack and we move it into the next project. Now you won't have twice as much equity. And so that takes about 2 years though to stabilize a new property and start paying
Right.
on distributions. The first year and the first and second years when you get most of your taxes, so you get big tax benefits, you get paper losses from cost segregation. And that's a study. Engineers do a study on your property and they give you a piece of paper that says you can write off this much. And with the Trump's big beautiful bill, you can take 100% of the bonus depreciation. So we write all that off years 1 and 2 because it's whenever the buildings go into service. So we build multiple buildings on our site. So it usually takes 9 months for the first building and up to 15 to 16 months, 15 to 18 months, all the buildings will be complete. So whatever building comes into service in that year, you can take your tax benefits, and usually it's split into 2 years. Sometimes if they come out in January, that whole year might be 1 year, but it's very rare that they come online in 1 year.
Absolutely. And sorry, were you going to add something?
I mean, I can talk forever, but yeah, that's basically years 1 and 2, you get your tax benefits. Years 2 to 3, you get your distribution started. Then we look at a refinance and then eventually a sale.
Right. And one term you used in there I think is really important, but often overlooked is the 1031 exchange from selling one property and rolling into another one. Can you touch on that? Just we don't have to go super in
Yeah.
depth, but high level, make
Yeah.
sure that the viewers understand what that means.
Yeah. So a 1031 exchange is how you really create a huge snowball. you defer all of your taxable income, all your taxable gains, your capital gains all that can get moved into the next property. So you shelter those gains. So as long as you keep facilitating a 1031 exchange from one property to the next, you don't have to pay taxes on those gains. And then you can eventually put it into a trust, and you can have the trust attorneys figure out how to give that to your kids and not pay any estate tax as well. So uh, it's a huge wealth building tool that wealthy people use. And then some people say, well, take the 1031 exchange away and we'll create all this tax revenue. Well, you won't, because there's so much gains in there. It doesn't make sense ever to sell that property. But this is a way to take the tax gains from your first property. Then you can also refinance that property, pull all that income in that is not taxable because it's a loan. Now you sell and you 1031 exchange to the next property. Well, guess what? You don't have to pay any of those taxes are all deferred that you took from here, and you get all your taxes from the new project. So you take all the new tax benefits and you get to use those against your ordinary income if you're a tax professional. So you not only do you not have to, you can defer those taxes. You don't have to recapture any of the taxes you already took or your refinance. Go to the next property, take all of those tax benefits, that goes against your income. Plus you can refinance with no taxes, and now you can do it again. And you can
Absolutely.
keep snowballing that 1031 exchange. And so it's a very, very good tool to build and grow your equity. And then when you have a tax issue, if you have a bunch of taxes to pay, instead of doing that, you can sell a 1031 exchange and buy another property and now use those taxable gains or use those tax benefits to offset your gains.
Yeah, thank you for explaining that. And to put some numbers to that for anyone watching, using the $200,000 you example used, if you put $200,000 in this year, 2 years from now, sell that for 250, you have $50,000 of gains. If you just took that home and paid 20% capital gains rate, you owe $10,000. But if you can roll that into another property, you just made that 10 grand you would have owed the IRS help you generate more wealth, and you could keep repeating that over time, which can be massively valuable to the point you just made. And I think just to make sure we cover all the bases, I'm not a CPA, disclaimer, but I often tell people taxes could be the largest cost to you in your retirement, but it's also the greatest opportunity as well, because there's two halves of the tax code. One half they tell us about and they enforce. The other half never gets discussed unless you have the money and know how to research it. But there's actually a lot of advantages in there, because there's also 1031 is real estate. I'm not going to go down the rabbit hole because we're here to highlight you, but just to make sure people are aware, there's also called 1035 exchanges. That relates to life insurance and annuities, getting to roll those into other products without paying taxes as long as you do it in the right way. So just anyone watching, you don't have to memorize everything Dusten and I just said. Just know there are options out there to be very tax conscious and advantageous. And if you don't understand it, speak to someone who does, like Dusten, because it can make a big difference. So with that, and it sounds like so new builds is your primary work. The value you try to provide your clients is decreasing their effort while increasing their wealth. Is there anything else from a value proposition that we haven't discussed that you feel like would be important to highlight when it comes to connecting your clients, or not necessarily your clients, because we're not here just to sell your business, but real estate investment as a whole? Is there anything else valuable in that conversation you think that should be highlighted that hasn't been yet?
I think you highlighted already, but the millionaires, something like 95% of all millionaires own real estate. And eventually, all wealth goes to real estate because it's the most passive investment there is. So if you think about, okay, if you invest in the stock market, it seems passive, but you have to always figure out what's the next stock. And maybe you can go into a fund and they'll figure it out for you. But those businesses, every stock eventually goes to zero for the most part. So it goes up and it has its life cycle and it comes down. Real estate and land is one of the things that just continually goes up with inflation. And this is why all money, the biggest money eventually goes to farmland or land in general, because even real estate becomes too much work. When you have billions of dollars, the only thing that there's no work in is just putting it into some productive land. And then you have once a year, you have a transaction where you rent to the farmer.
Mm-hmm.
And so eventually that's why the yields are the lowest, right? So the more work that there is to do on the project, the higher your yield will be. So this is why a value add renovation in a super poor neighborhood tends to be the biggest value creation and the most amount of money can be made, but it's also going to be the most work and you have the most risk as well of losing all your money. So,
Right.
and all the way to farmland where you're going to make 2.5% on your money to a point where you can't even really borrow any money to buy farmland. But eventually, all the wealthiest people buy farmland because they have to put their money somewhere. So
Right.
all wealth eventually flows into real estate. So you should figure out how to buy real estate, and it'll change your family tree. And that's another benefit we provide is create generational wealth. By owning real estate, you can change how your family dynamic is. So my daughter's mindset is so much different than my mindset towards money because I own real estate and my parents didn't really own any real estate and they were always um, they liked the idea of real estate, but they did not have the abundance mindset. They had a scarcity mindset. And my daughters now have an abundance mindset where they just think that they'll be able to find the money somehow, and they always do. This is one thing. I don't really give them any money, and somehow they always have money, and they're never really struggling, even though I don't really provide them with that much.
That's an incredible point, though. I mean, the shift from abundance to scarcity mindset is huge. Or sorry, scarcity to abundance mindset is huge, right? And I think a lot of people that just hand it down because our grandparents' generation, like they literally were trying to survive. Whereas
Hmm.
nowadays, people have this mindset like they're trying to survive by trading their time for money and getting a paycheck, which is nothing wrong with that. But we're not really at that much risk. So if you're willing to take on some risk, you can see higher and more passive returns. And that's where I think you outlined that really well of the undeveloped neighborhood is the highest risk, the highest reward. The farmland, unless Armageddon happens, is always should always appreciate. I can't say will guaranteed, but should always appreciate due to demand and we aren't building any more land. So you kind of have to figure out what parameter makes sense for you there, and I think that's really well stated. So that's a really good, I think, overview of what you do and why you believe in real estate. Out of curiosity, I don't need percentages, but are you someone who believes only in investing in real estate, or do you also diversify into other asset classes? That's just your primary driver.
Yeah, I mean, I think you should have a little bit of everything. You should have a little stock market. You should have a little um, life insurance. You should have businesses. You should own all this stuff. But eventually, you have to own real estate. You just do. Everyone does once you get to a certain point of wealth. And for me, I like real estate because I always win in real estate. I lose a lot picking cryptos and stocks and different things. And I've always been able to win in real estate. And I feel like it's a for sure way for people that are not smart to become wealthy. And when I say smart, I don't mean like you're stupid. I mean,
Yeah, yeah.
are you a Zuckerberg where you can have these incredible ideas and you actually understand how all that works and you can make billions? Those are smart people, right? They don't need real estate. But for normal people, uh, owning real estate is a way that anyone can create wealth. And so that's why I love real estate, because as long as you can figure out how to hold the real estate, you can create wealth. And then you start getting to where you're not paying any taxes either,
Yep.
because the government incentivizes you to own energy, ag land, food, produce food, own energy, or real estate. And so when you start owning real estate, you reduce your taxes down to zero. Same with farmers. If you're a successful farmer, you pay almost zero taxes. And then if you're involved in oil and gas and energy production, you pay zero taxes as well. So now you own an asset that continually inflates and and can kick off cash flow if you're doing it right and can reduce your taxes to zero. So instead of paying 50% of your income to taxes as you get wealthier, you pay zero to taxes. And this is why all the wealthy people pay no taxes and they say the wealthy should pay their fair share while the tax code is written so they don't have to pay their fair share.
Yeah, and I don't want to argue with anyone on that point by any means, but the harsh reality of it is I've heard this many times. If you change the tax code, wealthy people aren't going to pay more taxes. They're just going to find a new place to put their money because
Yeah.
they have the money to do the research, pay the people, and unless the entire world is the same tax code, it's not that challenging for those with the know-how and the teams and the wealth to just shift it to where it's the most convenient, right? Because to your
Yeah.
point, whether it's energy, housing, and agriculture today, 20 years ago from now, the government might be subsidizing something else, or you know what I mean there. So point
Yeah.
being, be aware of what your options are, be aware of how they make them, how they can impact you, and have an abundance mindset to be willing to learn and take maybe a little bit of a different risk than what your parents or people that you know are willing to take, because it might not actually be that big of a risk once you understand the potential outcomes from it.
Hmm.
Do most of your clients live in one part of the country, or do most of your projects it's focused on one part of the country, or is it nationwide? Is it worldwide? Like, tell me a little bit more about where do you do most of your projects, or is it really diverse?
It's mainly the Midwest. We do most of our projects. We were buying some stuff in Phoenix and the Sun Belt areas, but what I realize is that the Midwest is the most stable and it's easiest for me to do business in a stable environment. You can make the most money in these other hot markets, but you can also lose the most money in these hot markets. So I understand the Midwest the best, and it's closer. So majority of our investors come from the Midwest, and all of our projects are now in the Midwest. We don't do anything in the Sun Belts and the Phoenix because timing is everything. If you don't actually sell your investment, you could potentially lose everything. And
Mhm.
so we like to just buy and hold and have that steady, slow and steady mindset and reduce the risk. We just understand these markets. So that's what you said about risk. If you understand what you're investing in, there's very, very little risk. Risk comes
Right.
from not knowing what you're doing.
Absolutely. That is a absolutely risk might be the most understood. What's the wrong word? Opposite of understood. Misunderstood. Thank you.
Yeah.
Risk might be the most misunderstood term in our society. And the example I use often, yours was great. I'm just going to add one, hopefully for context, is a lot of people think the stock market's risky, so they put their money in, let's say, a CD or a checking account. However, when inflation happens and our money deteriorates its purchasing power, it's possible all your money under your mattress at home or in your checking account could be exposed to higher risk than a long-term growth portfolio or a steady diversified real estate portfolio, because now your purchasing power has declined to such a point that you're at risk of not being able to afford your life, right?
Yeah.
So it's important to understand that the word risk is very broad, it's very gray, it's very arbitrary depending on the situation. So being aware of how the risk you're taking applies to your life is huge. So Midwest, you said because that's where you're most comfortable, it's the long buy and hold strategy. It's closer to you. Do you take into account the local or state taxes for the areas you target, or is it more about the culture and the location?
It's more about culture and location and mindset and education and income, but we do try to get tax advantages when we can. So if we can get TIFs, which are tax increment financing. If we can get one of those, it makes the project much better, reduces risk, increases cash flow. It also allows us to bring our rents down. So if someone says, we want you to come into our town, but we need the rents to be at $1,200 instead of $1,500. Well, if they can offset that with reducing our taxes, we can do that. And it reduces our risk because 1,200 is easier to afford than 1,500. So that's a way we can reduce the risk and we can provide a benefit for the community as well.
So, and do you usually have communities approaching you to do projects, or are you usually going to them saying, "Hey, I'd like to come into your community. What can you do to collaborate?"
Yeah, we find the community and then we go start talking to them. Once in a while, a community will reach out to us, but they're usually so busy they don't really have time. But all you got to do is reach out and ask them if they're interested in workforce housing or affordable housing or whatever buzzword they're using. So if you go on their website, you can usually see affordable housing is usually the top three of any single city council in any community that doesn't have bigger problems.
Right.
So if you have some larger problems, then maybe affordable housing isn't, but affordable housing is usually one of the top three problems. So when you go in there, you see whatever term they're using, if it's workforce, if it's attainable, if it's affordable, and you say, we can provide that attainable housing that you want. Are you willing to give us a TIF or a TID? A TID is a tax increment district. There's a bunch of different words for it. But there's usually all these lower level uh, grant or programs that aren't federal government. If you get tied up with the federal government, that's a whole different can of worms, and that gets very complex, and you basically get handcuffed. So we don't like to do any of those, like USDAs, any of those. We don't like to do them. We like to do the smaller, less intrusive programs where we can still manage and operate. the product, and then we're not tied to it forever.
That makes sense. What do you want the growth, or sorry, before I ask the future question, how long did it take you from you're working on the roof to you're built to this company, Mailbox Money, where you're connecting the investors to the build?
15 years ish.
Okay, so a lot of experience in there. And what do you want the next 5 years of growth look like? What does the future of the company look like? Are you expanding in different directions or just doing more of what you're
No,
already doing? What does that look
yeah,
like?
we're doing exactly what we're doing. We finally found a plan. So this is why I transitioned from design to raising capital, because we found a plan that doesn't need any design anymore. And so now I
Okay.
just have to do QC on it to make sure that it's built up to snuff. So I don't do that much design, not near as much design as I used to. So now it's all marketing to different municipalities that need this housing and to the local stakeholders that want to invest in these projects and banks. So we are just expanding now because we know this product is needed everywhere. So you're talking about a product that a young professional that's making 50 to 100K can afford and is brand new, Instagrammable, wellness design. It checks all the boxes of the what these young people want to live in. And it's their kind of like their starter home, but it's brand new, so it's something you're proud to live in. So now this is what you live in while you're trying to figure out, do I want to live here long term? Do I want to buy a home? And it's really, really good transitional housing from just outside of college to buying your first starter home
Some
or
yeah.
to
I live
transition to another community.
Yeah, I lived that world, so I can definitely relate to the need there of having being able to afford something when you're fresh out of college and trying to be an entrepreneur. So if it's so it's very similar design or exact same. So if you built in Thief River Falls,
Exact.
Minnesota, and
Yeah.
Madison, Wisconsin, it would look like the exact same thing, just two different locations.
Yeah, and if so, there's a little different plan. If the neighborhood is a lot lower income, or say stuff around it is not quite as nice, we can tone down the product. We don't have to have as big a patio doors. We can take off some decks, real small things, but we can reduce it probably by $5,000 per unit. But
Okay.
mostly what we do, there's almost nothing to cut out because we've cut pretty much everything we can cut off the project.
Okay. And so you're in private equity, and for people who are curious and they're like, "Hey, real estate sounds amazing." Could you just break down, in your opinion, the pros and cons of, going out and buying your own real estate property, going and investing in a private equity firm like yours versus just going out and buying a real estate ETF or mutual fund? Can you kind
Yeah.
of elaborate from your point of view the pros and cons of those three areas, or one maybe that I've missed is kind of the most common?
Yeah. So the ETF or the REIT is you're going to get about half of the gains. So you're going to make about 10%, but it's liquid. So you can go in and you can go out anytime you want. So the beauty is it's liquid and you make roughly 10% because it's they spread it out over everything. So they reduce the risk, therefore they reduce your reward. And they have lots of different layers. So you're paying a lot of executives. The part but you have illiquid and you have no control, right? So the when you go and buy it yourself, it is not liquid, it's illiquid. Oh, so wait, I said that wrong. It's liquid and you have no control. You can pull your money at any time, but you don't
Yep.
control it.
ETFs,
This one,
REITs,
yeah,
liquid, lack of control,
right.
your own home, illiquid, not
Yeah,
liquid. Yep.
and lack of liability, responsibility. You buy your own home, illiquid, full control, full responsibility, full liability, and you get about 20% over the life. If you own it for in between 5 or 10 years and you buy it right and you manage it right, you should make about 20%. Now, if you buy a home, single family home or duplex, you're gonna have to get creative to make that 20% because you're going to have to manage it yourself. You're going to have to maintain it yourself. You're going to have to lease it yourself. You're going to do all the work. With what we offer, you get almost the same return as the house. You'll get better tax benefits because we do a cost segregation. You can't afford to do a cost segregation on that property because it's too small. You got to have a fairly large project to do a cost segregation. We hire the best CPAs, all that stuff. It's passive. It is illiquid, but you have no responsibility, no liability. So the home, if something happens and you lose a tenant, now you have to make that payment yourself, or you have to have enough in reserves to make that payment. And so that is the liability, the responsibility of getting the tenant in there and fixing any leaks. If you go backwards on the house and something happens, you owe your investment plus whatever other money you owe. Where in ours, if something happens, you're only risking your investment, but it is illiquid, no control.
Right. So if I heard you right, and I think that was a pretty good explanation, it's basically the middle ground, right?
Yep.
Your REIT or ETF or mutual fund is going to give you the most liquidity, least work, but probably the lowest return of the three. Owning
Yep.
your own home is going to give you the highest potential return, but
Yep.
definitely the most work and liability.
Yes.
And by investing in private equity and trusting the experts, it's not liquid, but you are getting closer to your owning your own home as far as returns without the liability. Is that
Yeah.
fair?
Yeah.
And
And if you actually buy the right product, if you invest in the right project with say with us, and it's in the right neighborhood and it gentrifies, you will make just as much money as if you own a duplex and it does
right.
this, does the thing. So that's another key.
Right. And I think it's important, just a disclaimer, all three of those options you can lose money, right? We can't
Yes,
predict the future. We aren't guaranteeing by
absolutely.
saying this. This is just your professional opinion and advice from your experience. Just want to make sure
Yes.
we're clear on that. As a fiduciary advisor, and I know you use the word fiduciary earlier,
Hmm.
we can't make those sort of guarantees, but
Yeah.
that is the intention, right? So with that being said, and maybe you've already covered it, so just feel free to repeat yourself if it's the same answer, but in your experiences, whether it's from your parents and maybe a little bit of a scarcity mindset to starting on construction to owning your own business and developing, getting to where you are now, what is the single best financial lesson you feel like you have learned that's helped shape your life and where you're going?
Single best financial lesson I've learned. I would say it's all mindset. So you have to, well, as you say, abundance mindset, super important, but you have to learn all these ins and outs and no one's going to teach you. So if you go to your CPA and you say, "Hey, I heard I could do this." They're going to say, "No, you can't. Everyone would do that. If you could do that, everyone would do that." But then if you go to the wealthiest guy's CPA, they say, "Oh, not only can you do that, you can do this, 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 and this." But the wealthy guy CPA only works for 1% of the people. So they have to have 99% more of these lower level CPAs and only 1% of that CPA. And it's really hard to find that CPA because they don't take any clients and you have to get an introduction. So you have to always fight. You can't go in and say, "Hey, can I do this?" And one person says, "No, you can't do it." And then you say, "Oh, okay. Well, that guy told me I couldn't do it." You have to go in with the mindset of, "I know I can do this. I've seen people do this. How do I do this?" And you have to push, push, push. And then you have to realize, "Oh, I outgrew that person. And now how do I find the next person?" Because the information is there. You just have to go and seek it out. And you have to know that almost everyone you deal with doesn't know this information because that's who you're associating with. So that's why you have to associate with the next level of people, learn all their stuff, then the next level of people learn all their stuff, and that's how you keep growing in success. And hard work only gets you to a certain level because there's people that work way harder than I do and make way less money than I do. And so it's more about, can you get other people to work for you? It becomes way more about EQ than IQ. And so it's becomes all psychological, it's all psychology. And just knowing that you don't know anything, because if you did know that, you would be where they are at. So those people that are much more successful know a lot more about something than you do. And so how do you figure that out? But they're also not going to brag about it and talk about it. And so getting them to tell you the secrets is also not easy.
Right. That's fantastic advice. I love that. You said a lot of great things in there, but the easiest one to pull from that, I think, is it's not why can't I, it's how do I, and go
Mhm.
figure it out and find the right people, right? So, if you could only give, and it might be the same thing because you said it was your lesson, but I'll ask it anyways, just in case there's a slight twist. If you could only give one piece of advice to the people who watch this video or listen to this podcast, what would it be if it's different than what you just said.
It would just, you have to go get started. You have to take action.
Perfect.
What is it?
And
Ready, fire, aim. So you don't,
yeah, yes.
you will
It
never
sounds goofy,
really,
but yes.
yeah, you'll never really learn it until you go
Right.
do it. You
Right.
can read all you want about it. And that's
Yep.
very cliche advice, but I've found that that's the best thing you can do is you have to scale. You have to continue growing. How will you be able to do it if you don't know how? Well, the only way you'll know how is to go and do it. And this is
Absolutely.
why if you want to, this is the biggest mistake I made is not scaling, is trying to grow instead of scale. And so as you scale, you go deeper and deeper and deeper, deeper into your niche, and everything becomes automated because I can go buy a house, and that's just as hard for me to go buy a house as to get a 100-unit development under contract.
Right.
So I can go and develop a 100-unit contract or a 100-unit apartment, put it under contract and develop it, or I can go buy one house and flip it and bring in and change the carpet and do all that and have one tenant. So I built a system so either one I do is the same amount of work. And so you just have to go and do, and then you scale. So you buy a single family home, then you buy a duplex, then you buy a fourplex, then you buy an eightplex, then you buy a 20plex, then you buy a 50plex, then you buy a 100plex. But don't go and buy the 100plex because you make one mistake and it'll bankrupt you.
Yep.
So you learn on a small scale all these mistakes, but the only way you grow is to push yourself out of your comfort zone. Then you start buying 100 unit every month, then you buy one every week, then you buy one every day. Then you buy maybe you go to farmland. I don't know. But eventually you just have to continue growing and growing and scaling and scaling. But growth and scale are two different things.
That's fantastic advice. Absolutely. I love that advice. Have you read the book 10x is easier than 2x?
I don't think so, but I did read some 10x. Maybe I have read that. I might have. Yeah, I might have read that
I'm
book.
in the
I
middle
used
of it
to
right.
read tons and tons of books like that, but after you read 50 of those books, you kind of realize they're all the same.
They're kind of repeating each other different ways. I like to look at it
Yeah.
as adult learning. I don't remember everything I hear the first time. So if I happen to hear it a second or third in another book, it's not a bad thing. And
Yeah.
it's better than like I'm not a huge music person. So if I'm driving for 5 hours, I might as well listen to something. But
Yeah.
you basically just outlined the entire book with what you just said. And that was fantastic advice. Scaling is so much more effective than just working harder or working more. Right?
Yeah.
We can't get more time. So how do we make our time more efficient? By scaling what we're doing rather than just doing more. So that fantastic advice. Thank you for sharing that. What is your definition of being successful?
Um, Time freedom, probably.
Perfect. Be able to
Time
do what you
freedom
want to
and
do when you want to
peace.
do it. Yeah.
Yeah, peace. Do you have actual peace, or do you constantly have to distract yourself with different things? So I mean, I think success is whatever somebody else has. uh, but yeah, I mean, that's what I'd say. Success is mainly time freedom. Are
Okay.
you able to do what you want to do? And then when you get to do that, you actually might realize, oh, I didn't even want to do that. I want to go back to work. I like working better than fishing. So
Well said. Sometimes people will try to do what they think other people should make them want to do. All right, so we're running out of time. We're getting close here, but so I want to make sure. Is there anything else about yourself or your businesses that we have not covered yet that you feel like we should share with our audience?
yeah, Jesus is king.
Perfect. I appreciate that. For someone who wants to learn more about you and your businesses, what's the best way to find information or get in contact with you?
Um, Mailboxmoneyre.com is our website, and we have all the contact information. You can sign up for a Calendly link. Otherwise, Dusten, Dusten Hendrickson on LinkedIn. That's where I post most of my lifestyle stuff. We'll do business and lifestyle, and then you can kind of just follow along with whatever we're doing.
Perfect. Well, with that, I will just thank the audience for taking the time to watch or listen to today's Money Not Math episode with Dusten Hendrickson, Mailbox Money. Subscribe to my page and please help me provide more value to more people by sharing with a friend or on your social media page, plus commenting with a question or a thought. If you ask a thought or a question on my page and I don't know the answer, I'll reach out to Dusten, or if it's for Dusten, I'll get in contact with him and get back to you. Disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. Thanks again for your time, Dustin. Thanks for everyone who watched or listened to this conversation, and hope you all have a wonderful rest of your day.
Hey, thanks a lot for having me, Drew.
Absolutely.